Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about Trump's tariffs and the latest inventory data. Logan, welcome back to the podcast. And the first thing I'm going to say is hilarious meme about kung fu fighting between Powell and Trump that you put on your social. I just have to call it out.
I got a new video AI app. All hell's about to break loose on social media with the stuff that I could create now. So that was it's really interesting how, because we have this conflict between two powerful people in America, but you could also make it funny, make a light joke of it that either side can laugh at. But welcome back to America.
Thank you. Yes, I am back stateside and I'm in our office and I'm very excited to be back.
Yes. So while you were gone over the weekend or flying back, we have a quote unquote deal with the EU. The 10-year yield hasn't done pretty much anything really. Volatility has been so boring. Boring is a good thing with rates sometimes. People can operate a little bit more efficiently. But, we had talked about how Japan could be the first one announced. And because of the conflict with the BRICS nations and Trump now, that India might not happen as soon as some people thought, but the EU would be the next one. So that's there. It really does look like we're going to have, 15 to 20% tariffs around the world. The interesting aspect was President Trump was talking about checks again, giving rebates to people. The tariff money, a lot of people thought that would go straight to the deficit, but President Trump talked about he can use his money to his own discretion, because he's bringing the money in. So that'll be an interesting next stage when all the trade war stuff are done and the percentages are there and then everything flows with a higher tariff. It'll be interesting to see what he does with the revenue. Because I'm pretty sure it's not going to pay down the deficit now if he was talking about checks, not all of it. So there'll be some, in the back of their mind, I believe they know this too. Once the tariffs are in, certain things are going to cost more. But if energy prices were lower and mortgage rates are lower, the president thought that can offset whatever tariffs are coming in and the general economy can consume. It will be more interesting. It'll probably be a 2026 story because we're almost in August and, a lot of stuff is going to get shipped in before Christmas. We'll get to see what happens with the tariff revenue. Do they give a freedom dividend check or something like that out to people and not pay down the deficit with the money or just some of it? That's something for a later stage, but you wouldn't be talking about rebate checks to low-income housing or low-income earners if there isn't something in the back of your mind where you think, okay, we are taxing people. We're collecting revenue as a tax. The tax looks like almost 1% of what GDP is. So there are going to be some consequences to that. So I'm curious if we will start to see the shift of some of the money coming back to households to a degree.
So how does the Federal Reserve look at that tariff? So say we had, just make it easy, say we have 15%, every country, all of our trading partners, whoever, what does that mean for inflation or how do they view that?
Austin Goolsbee said it best. He said, tariffs are a one-time price adjustment, but if they have a percentage they can work with and things start to flow right, the thing is that you got to get everyone to agree, right? And I think the trade wars are where people just start escalating off of each other. We do this tariffs. Once you get everyone on the same page and everyone kind of agrees to a rate, then the Federal Reserve can model it out. But when they raise their inflation expectations, they're really raising it for personal consumption expenditures. This is where I think the conversation does get lost on the internet. A lot of people focus on CPI inflation, but CPI inflation is really driven by service, rents are the big driver. That doesn't really apply to goods, pricing. So this is why the Federal Reserve, the more and more deals that are being made or percentages, it'd be interesting for their take on it, because they've always said we are modestly restrictive right now with rates. You don't need the 10-year yield to go down much lower to get near 6% mortgage rates, because if you get normal mortgage spreads, there it is. You get 6% mortgage rates basically, or right near there. So it will be interesting when the Fed comes out, what they think of any of the recent news that came out.
So that might be something that we hear this week with the Fed meeting, right? I would assume that
Yes.
that's one of the questions that he's going to address.
Yeah, I mean, they can't just let this thing just go aside anymore, because we're in the second half of the year, and as Powell said, if we did not have tariffs, we'd be cutting rates already. So the Federal Reserve needs inflation to pick up on the PCE sides, on the good sides, to actually, warrant not cutting twice. And again, even if they didn't have tariffs, they would have only cut twice. So we're talking about basically market pricing. And there's a lot of rate cuts being priced in 26 to 2027. That's a whole different story. We only focus really on what's happening current. But it'll be a very interesting Fed meeting. But of course, now with the EU done, we need more clarity on Mexico, Canada. China was punted away for some other time. So it's not. It doesn't look like we're going to get any kind of really good test since it's almost August. But who knows? The next few days, some things might come out, more deals. We'll see as that August 1st deadline gets closer and closer.
Yeah, I feel like the EU, at least that deal takes some of the pressure off, because we had this August 1st and almost no deals. So at least now there's something they can point to and say, we know what's happening with this partner.
Yeah, it just when the total picture is here, it really does look like a kind of a 1%, almost in a sense, a sales tax. But I'm more curious now on what they do with the revenue, because unless President Trump was not serious about giving checks to people, which there's a lot of things he's said, capital gains for houses, no income tax for up to 120,000, freedom checks. There's a lot of things he says that just weren't going to happen. So, but this is a little bit different, as we are getting revenue in because we're taxing now, right? We have just incorporated the highest net tax in recent history, because we're taxing goods coming in now.
Well, let's shift a little bit and talk about the housing market tracker, because we are about to be in August, so second half of the year, and we're starting to see a real shift, or at least I want to say a downturn, but it's not really a downturn. It's like a slowing growth of inventory, correct?
Obviously, a lot of people know Mike Simonson is now the head economist for Compass. The monthly webinars that he used to do for HousingWire, I'll be doing that. August 20th will be the first one. And for me, it's more about teaching the economics of supply and demand equilibrium using our Altos data. And what we have seen in the past, of course, Mike and I, we're not mortgage rate lockdown people, but we're not mortgage rate lockdown for two different reasons. Like, my thing is credit channels run inventory channels. The qualified mortgage law, when that changed, was the biggest residential financing law change in history. And it's created inventory data that looks much different than what it used to be in previous decades. But what happened recently, and for everybody listening to this, our data is different than the NAR and others. We don't count pending contracts in our inventory data at all. So we're kind of fresh, raw inventory as it is, right? It's what is available for sale, not what is available for sale, condos, pending contracts, everything. This is why the NAR's data is higher than ours. But I think there were so many people were surprised that the NAR's inventory data was slightly negative month to month. But if you look at how they track data, June, July, August typically is the peak. So we might have a month or two where you get a little bit of increase, but probably at the upper end of the inventory channel. I think last year October had a late cycle high inventory period, but that was basically the highs of the year anyway. But for us, we want to track raw data to see, because we want to get ready to look out for the future. And inventory growth started to slow 2 weeks before July the 4th. Nothing spectacular, but it wasn't growing fast anymore. When we had a very good year on inventory growth. It was the best thing about housing for 2025, but it started to slow down. New listings data is very seasonal, but it looks like to me like May, the end of May was the peak of new listings data, and it's doing its seasonal decline. However, rates have been stable, but they're higher. So this is the different variable in 2025 that we have not, that we in 2023, 2024, we've had mortgage rates head down towards 6%. Both times demand grew. The supply and demand equilibrium changed, especially on pricing. So I want to see, going out for the rest of the year, even if the NAR's total inventory data has peaked and will start its seasonal decline, what happens if rates go one way or the other now? Because we've been so stable with mortgage rates because the spreads are better. So even if the 10-year yield goes up, mortgage rates aren't going to have that accelerated kick up anymore. Like, we were showcasing this over the weekend that 2023, we can't have 8%. Like, a lot of people are saying, oh my God, mortgage rates are going to go to 8%. No. You need spreads to get worse. You have to have some kind of economic event to have the spreads. You can't get 8% rates anymore with a 5% 10-year. You need to be much higher. So now the spreads actually get better as yields go up. They get noticeably better. So now we have an interesting backdrop. What happens if the 200-day moving average of the 10-year yield breaks and we go lower on the 10-year yield? Mortgage pricing gets toward 6.25% or 6%. Does that change the supply and demand equilibrium like I saw last year? Like, I knew my price forecast was wrong because mortgage rates are heading towards 6%, and I was going to be too low. But now inventory is higher than it was last year. So it becomes more interesting. Now, let's just say a hypothetical. Let's say rates somehow reverse aggressively. Inflation takes off. The Fed gets very hawkish. The markets don't like it. Spreads get worse, something like that. How bad does it get? Because in the past, we've had our inventory data stay higher for longer toward the end of the year. That doesn't get really picked up by the NAR and anyone else. But ours is a fresh, raw, and almost naked on the beach inventory, no contracts, nothing. Those are homes that are just sitting there. So that's the curious part, because the growth rate has been slowing down. If I take the July the 4th chaos out of it, we have had a slowdown on the week to week. It's slowed down so much that the year-over-year percentage growth has fallen a few percent. And we'll take it from there going out for the rest of the year.
So, I think what we've seen before is that if mortgage rates fall, then more people come in to buy. So then your inventory falls. That's why you were team higher rates when things were so crazy in 2021.
So inventory always rises in the spring and summer, and then it always has its seasonal fall. It's the growth rate of what happens. Take 2020 out of the equation. That was crazy, right? So in 2023, the early part, because rates went down to 6% toward the end of 2022, it took a very long time to get the seasonal bottom, and then we saw the seasonal increase. So we're almost at the time and period in traditional times. A few weeks out, we'll see the seasonal declines. But does the lower rates slow down the growth even more? Do we actually see the seasonal decline faster than what we've seen before? Even though rates are elevated now, it's not having the kind of impact right now that we would normally see. So this is why I love the tracker, because we don't have any contracts tied to our work, right? We get to see it raw, and then we get to see how these homes are available for sale, not in a pending form. So we get a good idea. And again, I love 2025 more than any of the years because it's balance, right? It's balance, and the new listings data It got to the low levels of what we were normal, but we did not see stressed sellers again. This is year three. This is year three of the lowest home sales ever recorded history. Again, we always like to show the difference between 2005 to 2008 and 2022 and 2025. These are two historical periods. You could even tie the early 1980s to this, where we see home sales crash and stay low, but the inventory channels look different. Why? Because qualified mortgage changed the entire housing economic landscape forever. And we've had an unbelievable test run right now with the last 3 years, what happened with home sales.
So one of the data points that you always point out is the low that we saw in 2022 for inventory, which was 240,000 houses for sale in this giant country, right? And now we're over 860,000?
We're around 860,000. Now, normal would be about 1 million, but as you can imagine, I was not a fan in 2020, 2021, 2020, early part of 2022, because when you have shortage inflation, it's the worst. You know, I mean, it's one thing if sales were booming or something like that, where demand just completely outstripped. And I always refer people back to, 2002 to 2005. Sales were booming, prices were booming, but inventory was growing, right? Inventory in 2005, when sales peak, was 1 million higher than the NAR's inventory data today. So it's just a different type of period, but you could see what was happening to years 2020 to 20. Inventory was slowly moving lower every year. And you're like, boy, that period could be trouble. That period. And guess what? We got into it right away. And then the issue is COVID was such a smokescreen because people were so worried about a depression and everything. And nobody cares about housing inventory data at that point. And the whole thing was, I just remember going to Bloomberg every single week in early 2020, guys, we have to worry about home prices accelerating out of control, not a deflationary collapse, and every month pondering. And then it was too late by that point. We were team higher rates early 2021. It just did it. They don't make the existing home sales market the foundation of monetary policy, which is kind of weird because that's what they really couldn't control. But the unemployment rate was still over 6%. So they didn't want to go there yet, but now it's much better. It's much better. Wages can catch up. Households are forming, price growth, and very similar to the early 1980s was interesting because we had a similar crash. Mortgage rates went from 18 to 13%. Home prices didn't fall during that period of time, but we had the fastest crash. But eventually, after time, mortgage rates fell, sales bottomed out, and then sales started to grow again. And people back then were saying, oh my God, sales can never grow. We're a renter nation. And then all of a sudden sales are growing and we go on. And this traditionally happens in a lot of housing cycles. But always kind of remember the hottest home price growth period was 1943 to 1947. 1974 to 1979 dwarfs the COVID, period of time. Whenever I show people what prices did back then, they're like, what? And that was with elevated rates, COVID inflation, right? Housing moves with inflation to a degree. That was, a very short amount of time where we had 2 years where it was unbelievable, 10% and 19%, but then rates went up, thankfully, in 2022. The growth rate of pricing came down from 18% down to 6% for the year. So if we didn't have that, we'd be in more trouble now. But again, all these things are positive because it sets for the future, right? We have to think of housing in the short, medium, and long term as well, and it's a much healthier market this year than that period.
So we've talked about rates, we've talked about inventory, you talked about purchase apps last week on the podcast and in an article. What else would you highlight from this tracker that you wanted to talk about?
That even with elevated rates, our weekly pending sales data is slightly positive year over year, but I caution everyone, we have unbelievably low comps. So take that year over year growth with kind of a grain of salt, that if we didn't have these historically low comps, then we wouldn't be talking about this. But to have the demand stay somewhat firm, even with another year of home prices rising, but it's rising much slowly now, it just shows me that when rates can get to 6%, that demand actually can pick up. And every year that goes by, we're just missing that natural home buyer that's there. So those people are sitting there. They're just piling up now, right? Every year that we're near 4 million total. And for those that have followed our work for a long time, even those that followed me in the past decade, 4 million is that key level for me always. After 1996, it's really rare to go below 4 million. We can do it on the monthly sides, but we haven't, even the last 2 years, total home sale or total existing home sales have never breached under 4 million. But we're just hanging around here. So even with elevated rates, everything's still somewhat intact, but mortgage rates just getting to 6. It's very hard for me to go below 5.75 with monetary policy where it is, where the spreads are at. We would need more rate cuts and the spreads to get better, to get down below those levels. But you have to think about it that 6.5% to 7.5%, it was the high level range of rates here. 5.5% to 6.5% mortgage rates can be the low level range. And that is an ultra low mortgage rate policy or Federal Reserve policy anymore, because we stayed at 3.25% to 5% for a decade, right? Home prices weren't escalating out of control. Home sales weren't escalating out or anything like that. But that's kind of maybe the mindset down the line out there. If we don't get inflation from tariffs, if the Federal Reserve and the spreads do get better, that's a more plausible scenario, 6.5% to 5.5%, than to go sub 5% or 4.3%. So many things have to happen that you shouldn't even think about that. But we've got down to 6 twice, and we've tested it, and it reversed every single time. But just getting spreads back to normal, we always highlight the spreads every single weekend, and we said that if the spreads were normal, we're near 6% today with a 10-year yield at 4.41%. So there are 2 variables now that can help get to that level. And the only reason I talk about this is that 6.64 to 6%, the data gets better. Okay, we've only had that happen twice, but the forward-looking data gets better. And that's a more workable rate variable than what we have dealt with than what other people are talking about.
In comparison to what we've had over the past couple of years, you get to 6, people think that's a great deal. You get to 5.75, and our industry would feel like that's a real tipping point, because 5.75 would absolutely draw some people in.
I mean, when you're a vampire and you haven't taken drinking a glass of blood for like 1,000 years, oh my God, that first drip is going to be, So again, this is why I always highlight, this is the 3rd calendar year of the lowest home sales ever. It's not like, it's interesting because post the great financial crisis, we had more inventory and housing was more affordable. But my whole working model back then was that 2008 to 2019 would be the weakest housing recovery ever recorded in history. New home sales, housing starts, mortgage demand. Purchase application data is never going to hit 300 until we get to years 2020 to 2024. Voila. That's what happened right there. Housing starts are never going to get to 1.5 million until years 2020. That happened as well. But back then, we had so many underwater mortgages. That was a mortgage rate lockdown rather than a real mortgage rate lockdown. If you can't sell and take the equity out, you lose that buyer. Demographics were more for renting at that period of time. You work your household formation and demographics up to years 2020. And now we're here, just, it's a little bit of a better spot on the demographic side. But however, a lot of equity, a lot of selling equity for mortgage owners, right? There's 40% of homes that don't have a mortgage, right? So, but everyone else, there's a lot of selling equity there, but sellers are stingy. They just, people don't realize that, people go, why don't you just cut your price $12,000? I mean, that 12,000 hurts people, so it's always been this case, right? And, this was one of the things I was hoping, with so much equity, we could have a more buyer-friendly market. And you see that with concessions now. And this is why I love the housing market now, because you're seeing buyers get an upper hand. But it's like they are still very stingy. And part of that is the days on market, right? If you look at the NAR's days on market, it's like 27 days. Back in 2011, it was 100 days. It took 100 days back then. We're so far from those levels. So 2 different marketplaces out here. But Some encouraging things on that side, that we can have rates stay this elevated, not get into the range, and have demand still stay somewhat firm at these record low levels.
Logan, thank you so much for being on, walking us through all of those things that are happening. I will be talking to you again very soon because we have a big week.
Yes, on the day when the Fed meets. Yes, that's going to be a lot of fun. So if nobody saw the Kung Fu fighting video, come to my Instagram. You can see
it's pretty
Trump
funny.
And Powell just go at it.
All right. Thank you so much. Appreciate you.